Hey everyone, and welcome to this explainer. Today, we're diving straight into the massive macro and micro forces that are currently shaping Canada's housing market and the broader economy. To guide us through this, we're leaning on insights compiled exactly as per Deep Tour and as per the Amoxie real estate team, drawing directly on the latest data from TD Economics and True North Mortgage. If you want to understand exactly where the market is heading next, you are definitely in the right place.
Here is how we're breaking it down today. 1. The National Housing Forecast. 2. Supply, demand, and demographics. 3. The Provincial Economic Divide. 4. Real estate winners and losers. And 5. The Affordability Equation. Let's jump right in. All right, so let's start with the big question on everyone's mind. Are better days finally budding in Canada's housing markets? Look, we all know the country's in this massive tug of war right now. We're coming off a historic pandemic peak where prices just absolutely skyrocketed. And that was immediately followed by a sharp, painful correction driven by rising interest rates. Well, the data today is going to tell us if the tide is finally starting to turn. Section 1. The National Housing Forecast. A look at current prices and market balance.
To ground us in reality, the national average home price sat at exactly $667,700 in May 2026. Now, this number is absolutely critical. Why? Because it's a staggering 21% below that incredible peak we saw back in March 2022. While that represents a major cooling off period, data from True North Mortgage is telling us that the market isn't in a freefall. We are actually finding a new floor. A huge indicator of this new floor is the sales to new listings ratio, or SNLR. Right now, the Canadian market is sitting at a 49.2% ratio. Basically, anytime you're between 45% and 65%, economists consider that a balanced market. That means, at this exact moment, neither buyers nor sellers have extreme leverage over the other. Inventory and demand are matching up relatively evenly, and that's acting as a solid anchor keeping national prices stable. Moving on to Section 2, Supply, Demand, and Demographics, the push and pull forces shaping future availability. So after years of record-breaking immigration, Canada actually just experienced its first ever population contraction. As government targets were adjusted, we saw a historic outflow of over 660,000 temporary residents. And this massive shift acted like a giant release valve, taking a huge amount of the immediate boiling hot pressure off major real estate markets like the GTA and Greater Vancouver. But hold on, because even with that demand easing up, we are still dealing with a massive structural problem. Canada is projected to be short 5 million homes by 2030. 5 million. And builders are facing a brutal combination of headwinds right now. We're talking higher energy costs, less access to materials due to trade policies, restrictive government taxes, frustrating red tape, and severe construction labor shortages. They literally just cannot build fast enough or cheap enough to close that gap. And adding fuel to that fire is one of the most stubborn roadblocks out there, NIMBYism, or not in my backyard. You know how this goes. This is when established neighborhoods push back aggressively against adding multi-dwelling housing to their streets. We actually just saw this play out in real time in Calgary. They introduced blanket zoning laws specifically meant to increase density, and then rapidly repealed them because the intense local pushback was just too much. Section 3, the Provincial Economic Divide, an uneven pitch across the country. When you look at the economic drivers of the country right now, it is a tale of two absolute extremes. On one hand, you've got booming, energy-rich provinces like Alberta experiencing record oil output, strong job growth, and soaring energy revenues. But on the exact opposite side, you have cooling provinces like Ontario and BC. Because they're heavily exposed to trade, they're facing massive economic headwinds from CCMA renegotiation fears and a serious drag in manufacturing. You can clearly see this uneven pitch in the 2026 GDP forecasts. Just look at the numbers. Newfoundland and Labrador are surging ahead at 4.1%, and Alberta is hitting 2.1%. Meanwhile, Ontario is crawling forward at just 0.4%. To put that into perspective for you, that is Ontario's slowest non-pandemic pace of growth since the global financial crisis. The country is well and truly moving at two completely different speeds. That brings us to Section 4, Real Estate Winners and Losers. Where are home prices dropping and rising? According to the TD Economics data, real estate forecasts are perfectly mirroring those broader economic struggles. Over in Ontario and British Columbia, home prices are drifting lower in 2026, dropping 3.6% and 1.8% respectively, before they start a modest rebound. But then look at Alberta and Quebec. They're experiencing sustained positive price growth straight through both years. It's crazy, but right now, your net worth is being heavily dictated by your province's industrial output. And this massive regional disparity creates some absolutely wild contrasts in the actual cost of buying a home. The most expensive markets, like Greater Vancouver, are sitting well over $1 million. Compare that to the most affordable markets, like Sault Ste. Marie in Ontario, which are hovering down in the low 300,000s. Do the math on that. You could literally buy 3 entire homes in Sault Ste. Marie for the price of one single property in Vancouver.
Finally, Section 5, the affordability equation, the path back to a pre-pandemic normal. So despite all the localized pain points and shifting economies we've talked about, the long-term outlook does have a pretty significant silver lining. As Robert Kavik, an economist at BMO, points out, the path back to pre-pandemic affordability is officially underway. Those extreme pandemic-era wild bidding wars and overnight price spikes, they're fading out, slowly being replaced by much more rational, predictable market behavior. And the data actually gives us a very specific 4-step formula required to get housing affordability back to a manageable level across the country. First, we need prices to remain flat so they don't outpace wages. Second, household incomes have to grow. Third, we need central banks to step down borrowing costs slightly. And fourth, this is the big one, we need builders to deliver new home completions. If those 4 things align, the affordability crisis actually begins to solve itself. As trade uncertainties hopefully start to clear up and interest rates settle into a predictable rhythm, both True North Mortgage and TD Economics are pointing to a massive market shift coming in 2027. So, considering these deep provincial divides and a totally shifting national landscape, we have to leave you with this. When the 2027 rebound hits, will your household be caught off guard, or are you positioned to capitalize on it?